SMART is a volatility long-short strategy. It has a long volatility component, a trend-following futures trading model which profits if markets trend in one direction over short time frames. This strategy benefits from the momentum effect, which is the observation that price trends tend to persist over time. It also has a short volatility component, which is an option selling strategy that profits if the market stays within a particular range. This strategy benefits from the volatility risk premium, or the observation that option prices tend to be higher than their expected value. If during the week the market moves outside of the options range, the trend following strategy will likely make a profit, while the options strategy will likely make a loss. If, however, the market stays within the range, then the trend following strategy may make a loss while the option strategy will make a profit. If you look at the return distributions of the two strategies, the futures strategy has a relatively small left tail and a fatter right tail. It has a positive mean return due to the momentum effect. The option strategy is the opposite. It has a relatively fat left tail, no right tail, and a slightly positive concentration, which is due to the volatility risk premium. However, because these strategies have opposite correlations to volatility, high volatility events that would be left tail for the option strategy are right tail for the futures, whereas low volatility events that are left tail for the futures are typically average or positive for the options. If you add these two strategies together, you get a return distribution which has a smaller left tail, a smaller right tail, and a more consistent and more positive weekly return. If you look at the equity curves for these two strategies, this is calculated using live data for the Nasdaq, which is one of our traded instruments. You can see that both the futures line and the options line are upward sloping, and their peaks and troughs overlap since they react differently to volatility. Therefore, if you average them out, you end up with a less volatile, more stable return. However, just because the strategy has generated stable returns in the past does not mean that it can't be impacted by future black swan events. To protect against these, we use enhanced risk management techniques. If the market is crashing, the futures strategy will provide protection, but we also have a long VIX strategy that buys VIX futures if the index moves above a certain barrier. We also have a dynamic long gamma strategy, which caps the maximum loss and allows us to profit if the market should bounce off its lows. Adding these protections slims down the left tail even further and caps it, resulting in a strategy that is able to safely and frequently profit from known market inefficiencies.